So, you sell an investment, you make a profit, but the price you sold it for, that's not the only number that matters. See, every single gain comes with a second price tag, the tax bill. But what if we started thinking about tax less like a penalty and more like a cost that you can actually learn to manage? Okay, let's dive right in. We're going to break down the key rules for U.S. capital gains for 2025 and 2026 so you can get a handle on that second price tag.
This is it, right? The moment every investor thinks about. You've made a great call, everything's in the green, and you decide it's time to sell. But the second you hit that button, this question pops into your head. And the answer, well, it's not just one number. It really depends on a few key decisions you made along the way. And that's exactly what we're going to unpack. You know, the single most important factor that decides your tax bill isn't actually how much you made. It's how long it took you to make it. Seriously, everything in the world of capital gains boils down to this one simple concept, the holding period. And the IRS is, super specific about this. The clock literally starts the day after you buy something, and it stops the very day you sell it. That chunk of time, your holding period, is the fork in the road. It sends your profits down one of two very, very different tax paths. And here they are, the two paths. Now just look at the difference. If you hold an asset for 1 year or less, that's called a short-term gain. And the profit? It gets taxed just like your regular paycheck at your highest income tax rate, which can be all the way up to 37%. But what if you hold on for just one more day? Well, the whole game changes. It becomes a long-term gain, and the tax rate plummets to 0%, 15%, or 20%. That one day can save you an absolute fortune. And this chart just drives that point home. For a high-income investor, you're looking at a 17 percentage point gap. On a $100,000 gain, that's $17,000 that stays in your pocket instead of going to the IRS. And the only thing you had to do to get it? A little bit of patience, just holding on for over a year. All right, so we've got the fundamentals down. Now let's talk about what's new for 2025 and 2026. There's this recent piece of legislation. People have been calling it the One Big Beautiful Bill Act, and it's introduced some really big changes, especially if you're someone who likes to invest in new up-and-coming companies. So here's the bottom line. This new law has basically supercharged one of the most powerful tax breaks out there. It's for something called Qualified Small Business Stock, or QSBS. Think of it as a huge reward from the government for putting your money into growing early-stage companies. This is a massive opportunity to invest in startups and potentially pay zero tax on your gains. So the old rule was you had to tie up your money for 5 full years to get any benefit from QSBS. But look at this now. For stock you buy after July 4th, 2025, the law is way more flexible. Hold for just 3 years, and you get to exclude half your gain from tax. Make it to 4 years, that jumps to 75%. And if you can stick it out for 5 years, you hit the jackpot. 100% of your gain is completely tax-free. This is a total game changer for early-stage investors. And if that wasn't enough, the prize just got bigger. The law also boosted the maximum amount of gain you can exclude for each company you invest in. It used to be $10 million. Now it's a whopping $15 million. It's a pretty clear signal that the government really wants to encourage bigger, bolder investments into the small business economy. Of course, not everyone invests in just stocks and startups. The tax code has some special nooks and crannies for other types of assets, so let's just quickly run through a few of the most common ones. Okay, so if you sell collectibles, we're talking things like art, gold, maybe even some rare antiques, your profit is taxed at a special maximum rate of 28%, a little higher. Then there's investment real estate. The part of your gain that came from all those depreciation deductions you took, well, that gets recaptured at a 25% rate. And finally, some complex financial products like index futures get this special blended rate, which works out to about 26.8% right now. Not a bad deal compared to the top short-term rate. You know, knowing the tax rates is one thing, but honestly, the real money is saved by not stepping on the financial landmines hidden in the tax code. And trust me, there are a few big ones that are surprisingly easy to fall into.
And hey, don't just take my word for it. If Albert Einstein thought this stuff was complicated, then we can all forgive ourselves for needing a bit of a roadmap. So let's diffuse a few of the biggest traps out there.
First up, we've got this little extra tax that catches a lot of successful investors by surprise. It's called the Net Investment Income Tax, or NIIT for short. And it's basically a 3.8% surtax that gets piled right on top of your regular capital gains tax once your income crosses a certain line. This tax kicks in when your income goes over these levels. But here's the real trap, the part you have to watch out for. These numbers are not indexed for inflation. They don't go up. That means every single year, as incomes and investment returns rise, more and more people get sucked into paying this extra 3.8% tax. All right, trop number 2. This is a rule designed to stop people from doing something very specific: selling a stock at a loss just to get a quick tax deduction, and then buying it right back the next day. This is called the wash sale rule. So the rule creates this 61-day danger zone around the day you sell something for a loss. If you buy a substantially identical security, which can be the exact same stock or even an option on it, in the 30 days before or the 30 days after that sale, boom, the rule is triggered and your tax loss gets disallowed. Now, a normal wash sale isn't the end of the world. Your loss just gets postponed, not erased. But there is one specific scenario where this rule turns into an absolute financial disaster, and it involves your retirement account. You have got to be careful here. Okay, lean in for this one. It's that important. If you sell a stock at a loss in your regular brokerage account, and then inside that 61-day window you buy that same stock back in your IRA, that tax loss is not deferred, it is permanently disallowed, it is gone. Forever. You can't use it. You can't add it to the cost basis of the new shares. It just vanishes. This is truly one of the most painful and irreversible mistakes an investor can make. Our final trap has to do with how you pass on your assets to your family. A lot of people think, hey, I'll be smart and gift some stock to my kids while I'm still around. But from a tax perspective, that can be a colossal mistake.
Here's why. When you gift stock, the person receiving it also gets your original cost basis. So if you bought a stock for $10 and now it's worth $100, you've just gifted your kids a $90 tax problem. But if they inherit that exact same stock after you pass away, the cost basis steps up to whatever the market value is on that day. That $90 gain? Poof, it's completely erased for tax purposes. It's one of the most powerful benefits in the entire tax code.
Okay, deep breath. We've gone through the rules, the new incentives, and the big, scary traps. So what's the game plan? How do we take all this information and turn it into a simple, effective strategy? At the end of the day, it really comes down to 3 strategic levers you can pull. Number 1, master the calendar. That 1-year holding period is your absolute best friend for slashing taxes on your winners. Number 2, hunt for the incentives. Those new QSBS rules are a massive opportunity if you're investing in private companies. And number 3, manage your losses with care. Understand that wash sale rule inside and out, especially the IRA trap, to make sure you get to keep your deductions.
You know, understanding all these rules isn't just about staying out of trouble. It's a genuine form of return. Every single dollar you save in taxes is another dollar that goes directly back into your pocket. So I'll leave you with this question. Looking at your own portfolio right now, what's the first tax-aware move you're going to make?